Ready?
Good afternoon, everybody. My name is Matt Bryant with Paladin Financial. Here we have Keith Gangl, a guest from Gradient Investments. I'll introduce him more in a moment, but today we're going to talk about portfolio selections and elections. There's an election coming up. It's a big deal. We're hearing a lot about it from our clients. So we want to take a moment to go through our process in selecting portfolios. Keith represents the firm we use primarily for portfolio management, so he's going to talk a little bit about what their process is for actually managing those portfolios. And then we're going to talk a little bit about elections and how elections can impact the stock market and the economy. I know just firsthand and sitting with clients over the last several months that we've had a lot of questions about this, and it's very common to have some concern about the elections and how it might impact your portfolio. So we're going to talk through it and try to put your minds at ease. So again, my name is Matt Bryant. I've been in the financial services industry for about 13 years now. I joined Paladin Financial back in July of 2023. I hold the Series 6, 63, 65, and insurance license as well. Basically, what all that means is I'm a bit of a nerd. Not quite as big a nerd here as Keith. So Keith is a chartered financial analyst. So that's really the gold standard in the portfolio management industry. He works with Gradient Investments, and they manage a whole host of different portfolios. Prior to working with Gradient, he worked with Thrivent. Many of you have probably heard of Thrivent here in the upper Midwest, where he won the Lipper Award twice. Yes. Not something you brag about, but too often, really that's the pinnacle of achievements in the portfolio management industry. But we'll give you a moment here to introduce yourself a little bit more.
So I'm Keith Gangl. Matt, you obviously know me. I've been doing this for almost 30 years, so I've had a lot of experience. I used to have a lot more hair. My beard's a little more gray right now. So election season. So I'm looking forward to having this discussion today. So again, I've seen a lot, and we'll get into the meat and bones of how we select our portfolios, how we're selecting stocks, and how that the election could potentially impact it, and kind of how your clients should think about things. And obviously there's a lot of noise around this election, so hopefully it'll put some minds at ease when
it seems like the last few elections, each one gets noisier and noisier, and we'll talk a little bit about what happened in those past elections and what to expect going forward. Now, Keith and the rest of the team at Gradient Investments, their opinions valued, so you can see a few outlets here: Bloomberg, Reuters, Investment Business Daily. They are regularly featured on these programs. In fact, Keith, this morning you were on.
Yeah, just a half hour ago, was on Reuters talking about the economy, kind of Target's earnings report, and just kind of what we think Jackson Hole's coming up with big economic activity. So again, we're in front of the media. They kind of value our opinion, so it's nice to go out there, and it's great talking to you with Matt. The election is really kind of the hot button most advisors and clients want to hear about, and hopefully what we tell you kind of puts your mind at ease, at least puts it to the back burner on your financial picture.
And the reason we bring up Gradient Investments is they are a strategic partner of ours where we have access to them on a regular basis. So when we're not meeting with clients or doing our own research, we're communicating with you, just get a feel for the lay of the land and things we need to be looking out for as far as how to select portfolios for our clients. So today we'll dive a little bit deeper on the methodology behind selecting portfolios. We'll go into market volatility. That's obviously a big concern for a lot of folks, and what impact the election will have on that. And then we have a few Paladin related announcements at the very end. So as we get started here, first off, we want to talk about the methodology of portfolio selection. So all of our clients and all of our potentially new clients will go through something called the Paladin plan. So most of you probably recall we sit here in our conference room and we pull up on the screen the Paladin wheel, and we talk about all the different areas that we can help with your financial life. And it's not just portfolios and investments, but we cover everything from taxes, estate planning, insurance, all that good stuff. But at the end of it is portfolio management. And what we do is we use the portfolios available to us as the building blocks or the foundation for our clients' overall strategy. There's thousands of different portfolios out there to choose from. Our job at Paladin is to do our due diligence and homework and see who's the best of the best and who do we feel comfortable using with our clients. Now, a lot of folks may have similar portfolios, but no two people really have the same specific allocation. So our job is to look at what portfolios make the most sense right now, look at each person's investment profile, income needs, age, the types of money you have, all those different things. And then we say, based on this and based on the outlook from the portfolio management team, who Keith represents, what strategies make the most sense. So then we go in and pick those building blocks to help build plans for our clients. And then as life happens and things change, we're adjusting those as necessary. Now, Keith, take us through the process that you and the fellow CFAs go through when actually managing some of these strategies.
Yeah, so I manage three different of our stock portfolios. One's the Core Select, which a lot of your clients use, and a lot of your clients, when they come in, they want exposure to the overall market, and that's kind of what the Core Select will give you. We'll have some growth stocks in there. I'm sure you've heard of the Amazons, and all those names will be found in the portfolio. We also have, value names like your Home Depots and, things like that, that pay a nice dividend. And we'll have some core names like a Costco, which is in there. So
sure.
I, as a portfolio manager, I'm an active portfolio manager. The whole team is. Anytime you're invested with one of our graded portfolios, they're actively managed. What I mean by that is we're picking these stocks, which of those names I just mentioned are in the portfolio and which ones won't be. Now, for this portfolio, I'm talking about the Core Select, we're looking at the market where generally people are talking about the market, they're talking about the S&P 500, right?
Correct.
That's 500 companies that are in the index. We don't necessarily own all 500 of them.
Mm-hmm.
We just want to own between 50 and 80 of our favorite names. And that's why we're actively managed. Again, there'll be some times like Target, I just talked about on TV today. It's a name I own in the portfolio. I liked it for a while. They just had a good quarter and the stock went up a lot. And I also own Walmart. But at some point in time, Walmart may be too expensive. I'll sell that, maybe buy something else. Maybe I want to buy a different tech company. So that's what we are with active management. Now, you guys, you're one of our biggest and best advisors to work with. You customize these plans. You're meeting with the client saying, okay, is the Core Select the right portfolio for them? And now, me as a portfolio manager, I look at all the economic news and earnings and decide which names I want to put in and out of that portfolio. So you guys are making the allocation decision. We're making the actual decision of what goes in and out of that portfolio.
And our job too is looking at the investment universe, is selecting which ones we feel make the most sense, not only for specific client scenarios, but just do we want to be more US based versus international? Is, value versus growth, all kinds of different things that we look at. A lot of our clients do own the Core Select, and a big reason why is what I tell people is you need to have some stock market exposure. Even if you're a conservative investor, you need to have a portion that's there to outpace inflation and grow over time. The nice thing about the Core Select is when I tell people, tell them about the portfolio is when you leave your house and you go about your errands or you drive to work or whatever it may be, and you look around, like the companies you see out and about are the companies inside the portfolio. Yep. There's not anything speculative.
Not Bob's Bucket Shop from Taiwan or something, right? That you've never heard of. These are all the names that I own. Most of you recognize.
Companies have been around for decades. Yep. Solid companies that make up the backbone of the U.S. economy. Yep. So it's a comfortable way to go about investing. And then the last bullet point here, all in or all out. We get this question sometimes where there may be uncertainty, maybe a lot of volatility in the stock market, or there's some big thing coming up, i.e. an election. Clients will ask, when do you go to cash?
Yeah. No, as an active portfolio manager, we don't. We want to be invested in the market. We don't know. A lot of times you think the worst case is going to happen, and all of a sudden say you went to all cash and that didn't play out, and the stock market goes up another 5-10%. Your clients want to be in the market. They don't want us to make the decision of being all in or all out. You certainly, as an advisor, you can say, okay, we're going to take maybe 5% of your overall allocation and move it to a money market portfolio or something like that, something a little more stable, some other CDs or in your savings type of thing. But us, we don't believe that all in all. It's so hard to time the market. Again, I've been doing it for 30 years. It's pretty much impossible. Even you talk to the experts of experts, and it's impossible because the problem is you have to make two decisions then. If you go all out of the market, when you need to go back in, and as soon as the market goes back up, and all of a sudden say the market's up 20%, do you think you really want to go admit that you were wrong for that 20% that you missed and go back? It's hard. It's another decision you need to make.
And usually what we see is you capture most of the downside, make your decision to get out, and you miss the rebound. And we'll talk about corrections here in a moment, but the philosophy is don't be all in, all out, because it's a fool's errand.
Yeah, the prime example of that would be going back to 2020 when COVID hit, right? And the stock market was down a matter of 35% in a matter of 5 weeks. We didn't know when the bottom was. We're getting calls from clients and advisors saying, oh, my clients want to get out. And we're like, no, don't get out. Stay in the market, stay the course. Over time, market goes up. We don't know when the bottom is, but what ended up happening is the market actually doubled in the next year. Think about that. The economy went from collapsing. People were selling, and you were getting some calls from clients that wanted to just get me out. I don't know what's happening, and it's just like, all of a sudden that person missed a double. So that's a pretty big mistake to make.
And think about it from a perspective of you've spent 30, 40 years building your nest egg. You don't want to make a decision in a matter of hours or days that could potentially derail you for years. So, and it was 2 weeks ago, we had the stock market was down 3% on a Monday. We had some concern calls and whatnot, but for the most part, people stayed the course. By the end of the week, the stock market was positive.
And we've almost recouped. The market sold off about 8.5% from that peak to that, including that Monday. And I think we almost recouped almost all of that. Again, you guys did a great job. We put out a video out as well saying, we're not exactly sure what's going on in the market, but it seems like a little bit much. And again, the market's been up almost 18% year to date. So, I mean, any little thing can cause the market to pull back a little bit. But again, you guys do a great job keeping your clients invested. And again, you're not looking over just a 3-week period, right? You're looking over years.
And all that's to say is, you may see account balances dropping when times are tough, but it doesn't mean nothing's going on. Here are some of the things we do as far as managing risk. So when we sit down with a client for the first time, we do a pretty thorough intake of their risk profile. We do a various different exercises, get to know what needs they have, and then numerous options. There's all kinds of different things you can invest in. Some of them have deep protection, like buffered strategies. A lot of our clients have buffered strategies. There's absolute protection against stock market risk. So you think cash, CDs, insurance products. And then you've got full-on stock market exposure. So Keith talked about the Core Select. There's a million different stock portfolios out there. So ETFs, mutual funds, individual stocks, those are full-on risk. So our goal is to, even if you say you're conservative, you need some equity exposure, even if you're a moderate growth investor, you probably have some sort of liquidity or defense built into your portfolio. The process is how do you pick and choose to make sure we hit all those different profiles. And while a lot of our clients may have similar strategies, no two clients have the specific overall allocation. So we dive deep on managing for specific clients. And the last one there, rebalancing. That's a huge thing. Where last year the stock market was great. Ideally, you take some winnings off the table, and then you've got that in your back pocket. So when you go through a correction like we've seen this year, you already took your winnings off and you're protected. So.
Exactly. I mean, you guys do a great job up front. You're saying, if your risk scores, your commerce are 50-50, that means basically you're 50% exposure to the market, 50% in more safe assets. Last year, if the markets were up 20%, say that number creeps up to 60%, but your risk tolerance is still 50-50. So by the rebalancing, like you talked about, then you get them back to that 50-50, and they say you took some of that profits and put more in that safe money.
Yep, and we do that risk assessment every year to see what changes in a person's life. And if all of a sudden you went from a 60 down to a 45, we're gonna have a conversation about it. But that also is our opportunity to make adjustments inside the portfolio. All right, pivoting to
the fun stuff.
You may have heard there is an election coming up, and you get all kinds of different opinions on this. Keith, you may be surprised, but we live in a divided country as far as politics goes. There's a few key statistics up here, and they were a bit eye-opening to me. Yeah. So let's say you're a Republican, and if you think a Democrat's going to win, there's a one-third of the people out there believe that we're going to have a recession within the next 12 months. Basically, one-third across the board of all these. So they all think the other side is just going to ruin everything. You're going to plunge into recession. Electricity is going to get cut out. Taxes are going to go up. Whatever it may be. Yep. If the other side wins, it's going to destroy everything.
I think that's part of, generally consumers, anybody that has anything to do with financial kind of awareness, you're kind of a little bit more pessimistic. And so you're always fearful of the next shoe to drop, right? So it's like, my party doesn't win, we're going to a recession. My party doesn't win, the stock market's going to go down. I think that's just kind of a little bit of a human nature. Or the other thing is, if I buy this stock, I'm buying it, I'm the last buyer, and then the stock market's going to go down. I think that's just a little, so it doesn't really surprise me, but it's really not logical.
Yeah, and obviously the president is, they call it the most powerful person in the world. It's a very important position, don't get us wrong there, but might be giving too much credit to for sure what power they actually have over the stock market itself. Because again, the stock market's made up of companies. Companies want to build their business and make more money, and they know how to navigate different administrations.
Yeah, and then we talk about being an active portfolio manager. We invest in companies, not politicians. That's one theme to kind of remember as we go through the rest of these slides.
Yes. So here's the presidential election cycle theory. So this basically says that you can kind of plot out what the 4 years of a presidential cycle will look like. It says markets are lower in the first 2 years after a new president is elected, higher during the second year, with the third year being the highest. Election year average returns are higher than overall average returns. So we can see the chart here. So this is the S&P 500 with the presidential cycle. So it says year 3, 13.5% average return in the S&P 500, going all the way back to 1928. So
yeah, and that was last year, right? So year 3, which last year the stock market was up about 24, it's almost double that number. And so this year we're going to year 4, right? And so the average here shows about 7.5, and we're already up at 18. So we're in the last year and a half, we've doubled where expectations are. I think part of this is due to the fact that when a new president administration comes in, everybody's a little bit unsure what's going to happen. So maybe that's why the markets are a little more muted. And then you get to the second half of their term, and they generally want to get reelected. That's one thing we know for certain. Politicians love to be reelected. And so they ease up on maybe some of the regulations, some other stuff. And I think that allows the market to kind of elevate a little bit in the second half of their term.
Yeah, and we saw 2 years ago, so Keith pointed out last year was a really strong year of the market. That followed 2022, which was not a good year. And you can see that's the lowest year for average returns there. You talked about uncertainty, new president. We can think back to when Donald Trump was elected. A lot of uncertainty there, a lot of volatility initially, and he had some policies early on in his presidential run where there was trade tariffs and things like that.
That was the biggest one, yeah.
So there's some things that can spook the stock market. Ultimately, though, the stock market rebounded. And
yeah, I mean, the night he got elected, it was a little bit of a surprise in the market. It was like limit down in futures. I mean, it was going to open down pretty big, and ended up happening. The market turned around to itself and realized, okay, maybe the new guy is not going to be so bad. And again, we're investing in companies, not politicians, and the market ended up going a lot higher. We have a chart here later that shows you exactly how the markets go under different scenarios.
Yeah, I remember the night he got elected, I looked up the stock market futures, which is a predictor of how the stock market's going to do that particular day.
Yep.
2, 3 in the morning, I look at it, futures are down big.
Yeah, limit down, which means that the max will go down.
And I'm thinking it's going to be quite the day at work tomorrow. But by the end of the month, the stock market was up 8-10%.
Yeah, I think even that day it was close to slightly positive. So it was just, people just take a deep breath. Again, we're investing in companies, not politicians. And so I think it's an emotional time. So that's why we want to take the emotions out of investing.
I always think this one's an interesting one. So if we look at the time period, basically end of July through right up to election day, the end of October, if the stock market is positive, the incumbent party hangs on and wins, whether it's the incumbent president or in our case, currently it would be the Democrats stay in power. If the stock market is down during that period, you actually it's likely that the incumbent party doesn't win. So you can see 82% to the upside, or 82% chance that the incumbents stay in power if it's positive. And if it's not, then, I mean, nothing's certain in our world, but 88% is a pretty strong indication.
And right now I think we're running at slight positive because we had a negative start to August and we bounced back here a little bit, I think. So I think the net, we're slightly positive, but it's close. And I kind of get why if the markets are really aggressively sold off in the market in the 3 months prior to the election, that maybe people start feeling uncertain about the economy and other things as well, not just the stock market. So their pocketbooks maybe a little less, maybe losing jobs. It doesn't matter what party's involved. It's like throw the bums out. Let's get a new squad in to lead the team. So I think that's kind of, at least on the negative side of things, makes sense to me.
Very interesting. So this is a fun one. I think this is very eye-opening for a lot of people. How does the stock market do if there's a Democrat or a Republican as president? And then also looking at Congress and which party leads which house. So 15.94% return on average, so pretty strong returns. So don't let, again, the politics get in the way of everything. But here we can see up on the screen, we'll give you a moment to kind of soak this all in, but top row says Republican president, and then Republicans also control both the House and the Senate. Average return 14.5%. We go down to the bottom where there's a Democrat leading the presidency, and then we have a mixed Congress, 15.94%.
That's the best out of all the different scenarios right now.
So the main thing to pull from that, I think, is divided Congress.
Yeah, I think that's exactly what it is. Again, we're investing in companies, which, the companies, what do? They're spending CapEx, right? You're building new buildings, you're investing in products going forward. And the president has some influence on that, but a lot less than people actually think about. And so we like gridlock because there's no big policy changes, right? So it's like when gridlock is happening, not much is going on in Congress.
Yep.
And that's actually a good thing for our minds, right? Generally speaking, even if you agree with whatever policy is in there, generally speaking, it's better if nothing's happening because it's like, it's easier to plan, right? So if you're making a $3 billion CapEx project and you say it's in EVs or energy, it's kind of two of the extremes that maybe, politically opposite ends of the view. It's hard to make those decisions when it's gonna be all one party and all of a sudden you're making this CapEx spend and it goes against you. And then you have to pull it back. Whereas if it's gridlock, you're like, nothing's gonna happen here. I can spend going forward and this creates jobs and products and things like that. So that's what we like.
People joke about Congress being dysfunctional and they can't get along and nothing happens. Well, if you're the stock market, you actually like that.
That's a good thing. Yeah, we like that.
Stock market hates uncertainty, and when there's predictable dysfunction, who knew?
Who knew, right? Yeah, you wouldn't think that'd be the case, and that's just reality of it. And in CEOs, if you're operating a company, you do the best to sell your products or service, whatever it is, and you maintain your margins, things like that. And yes, the legislation can have some impact on your business, but generally speaking, a lot less than you actually think. The bites, are the barks worse than the actual bite.
Yes. And one last thing, while the third one there with Republicans leading the House, it's not near as high, but one thing we noticed consistently across those 4 different scenarios, the stock market's positive.
Yeah, and even in that situation, you have to take out it was a 9/11 situation, and it was the great financial crisis. Those 2 situations were in that category, so that kind of, I think, minimize that sentiment. So I think that would be a little more normalized. But again, these are, to your point, they're all positive regardless of what's going on.
Yeah. So talking about, because the president does set policy.
For sure.
Can do certainly, has power to make some changes. Congress obviously has to do a lot of things as far as taxation and whatnot, but generally speaking, Republicans seen as pro-business, pro-energy, as in oil and drilling and whatnot.
Lower taxes is kind of the other.
And lower taxes, which is seen as a benefit for not only households, but also businesses. Democrats seen more pro-environment, more regulations as the flip side of that coin. So as you sit back and kind of look where we're heading, I mean, how much play does this have on?
Yeah, like we showed you, I mean, just by what we just talked about, then you would think Republicans are generally better for the market, right? With less regulation, less taxes, that should be good. But we saw a chart where, Democratic split, it's actually a good thing. Now, the one other thing I like to point out, the example of Republicans are seen as pro-business and pro-energy, generally speaking, right? When Trump got elected, drill baby drill, right? A lot more production was. Do you think those energy stocks are actually good over his 4 years? They actually weren't. Right. They actually underperformed. There's other areas that would have been a lot better, which is kind of ironic, right? You think drill baby, oh, it's going to be good for all these energy companies, and it wasn't.
It comes down to a supply and demand issue, essentially, which is an economic force. So you see there at the bottom, like drill more. What happens? You have more supply. What happens when you have more supply but demand doesn't change? Your prices drop. So that can hurt a company. Point being is don't put too much emphasis on who's actually
who you think is going to be. Yeah, it's too hard to call. And the same thing with flip side, when Joe Biden and the Democrats got elected, it's like that's going to be negative for the energy stock companies. Actually, oil companies did very, very well under so it's a little bit. There's a lot more to it than just who's on top of the ticket. It's the economic cycle, what's going on, what's prices, like you said, supply and demand, what's the price of oil versus that demand.
Leads to a good point where we circle back to kind of what we talked about at the beginning, where you're not selling whatever oil company because a Democrat might get elected. You're looking at how much money is that oil company making? What's their valuation?
What's their fundamentals? Are they growing?
What's in the pipeline? Part of the pun. Like what? That is how you actually pick companies that people invest in. Not Democrats might be bad for.
I'm selling all my energy. That's a little bit. Obviously, the numbers prove it out. I think it's a little bit of a fool errand to do it that way. So I think again, we're looking at cash flow statements, evaluation. The fundamentals going to change, and maybe the fundamentals change a little bit, but the CEOs also adjust their business plans based on what's going to happen.
Yeah, those companies, a lot of those companies that we invest in have been around longer than any of these politicians.
Oh, sure, and they're going to be a lot longer than incoming ones.
Otherwise, they wouldn't exist. So now that's not to say there's not short-term volatility when administrations change, but it's not the long-term driver. So talking about policy, that a new Congress could see some changes. happened. We highlighted tax policy here. So this is an interesting one. So this goes back to the Trump era where they passed the 2017 Tax Cut and Jobs Act. All kinds of different things came out of it. We're going to focus on just kind of two key factors. This is set to expire at the end of 2025. So if nothing is done, which Congress is good at doing,
very good at doing.
if nothing is done, tax policy reverts back to pre-2017.
Yeah.
Two key changes for a lot of our viewers here and a lot of our clients. Income tax rates and brackets change, so they're set to increase. And if you've sat with us anytime over the last year or two, we've talked about which brackets are increasing by 15 to 20%, and the brackets themselves, so the range that you fall in, will change. And then this one may not impact everybody, but federal state taxes will reverse. So right now they are quite high, so most people aren't impacted. They're going to fall back down to a level that's actually much more attainable for a lot of folks. But talk a little bit about Tax Cut and Jobs Act as far as like what you guys see or what you're thinking of.
Yeah, I think this is actually the one area that's probably a little underplayed in the overall market. I mean, because if nothing happens, which generally speaking, a lot of times nothing happens because it's, it could be a split Congress. Who knows who's going to win? Who knows who's going to win the Senate? Who's going to carry the House? Because they're close. The country is really 50-50. So that's going to be a very close race. And if it's split, nothing happens, these tax rates are going up. And I think that would be a slight negative for the overall market that we're not pricing in yet. So we'll see what happens there. And we're just starting to see obviously, Trump policy, everybody kind of thinks he'll revert back to his first term, kind of what they are. So we kind of know what they are. Obviously on the Harris side of things, a little less unknown. I just read yesterday that the corporate tax rate is now, Trump cut it from 35% to 21%, right? So that's good for companies. Can they spend on R&D and research and do different things? Now that tax rate is expected to go, but if nothing happens, it goes back up to the old 35. Harris is proposing, I think, 28%. So again, directionally up, but not that 35%. So, but again, that's got to be agreement. If nothing happens, that could go back to 35. So it's something we definitely need to be worried about. And you guys do a great job of talking to your clients, especially on their own individual taxes, right? Because that'll impact them as well. So again, that's something we need to have a good eye on here coming forward. And I think the market's not too concerned about it, but I do think as next few months, it's going to get a little more concerned about it.
And if you've sat with us recently, if you're a younger client, we push pretty hard for Roth contributions rather than doing pre-tax, especially if you're in a lower bracket now versus what you're forecasted to be 20, 30, 40 years down the road. And then a lot of our clients that are close to or in retirement, we're big on Roth conversions. Why wouldn't you pay taxes at a lower rate now when there's pretty good odds that they're going to increase with nothing changing? So why pay those extra few percentage points on your taxes when you could get it taken care of now? So that's a big reason we push so hard for Roth conversions and why we say do Roth contributions, because the Roth IRA is that's one policy Congress came up with that's been
good. Yeah, no, there's certain things that Congress does well, but it's few and far between, it seems like, but that's certainly one of them. And I don't think most people would say that they don't see a scenario where tax rates are going down from here, regardless of who gets elected. So I don't see that happening. So I think you guys are doing a good job of getting in front of your clients and kind of talking about taxes.
Yes. So this is the one thing where, people call in and say, what's going to happen in the market over the next 3 months? What's going to happen over the next year? Don't know. You don't know.
I've been doing it for 30 years. My crystal ball is, you just don't know.
But we do know that over time they do go up. If markets didn't increase over time, nobody would invest in them. The companies that our clients are allocated towards, by and large, go up over time. They make more money, or else if they didn't make money, we wouldn't have jobs or companies to invest in. So
shrinking and be bad.
So it can be painful in the short term. We've seen a lot of volatility. That 3% day a couple weeks ago, it wasn't fun to check your accounts and see, oh, that's not good. But you stuck with it, and just a few days later it was up. So even when we saw COVID happen and the market was down 35% in 6 weeks, like by the end of the year, we were positive. So that's why we have a plan. That's why we are so diligent about sitting down and doing the reviews, because over time the market goes up.
The other thing about your plan is you're diversified, right?
Yeah.
So we're talking this market, but that's only one piece of your overall allocation as well.
So here, this is a nice chart. So we got the red and the blue with different presidential administrations. So start with Hoover, FDR, all the way up to Biden there on the far right. That yellow line is the S&P 500, and it's not smooth. We know that, but generally speaking, or not generally, but
over time
it goes up, and you can see each administration. I'm guessing there were people when Bill Clinton was elected that they thought,
yeah,
this isn't good.
I'm gonna take my money out because I don't like the other side, and they missed a nice run. Same thing, Bush, same thing. All these different runs at the market. Again, we're investing in companies, not politicians. And I love this chart. It's my favorite chart. How I end most of my presentations is it's like markets tend to grind up and to the right, regardless of who's in charge. The last couple of decades, the market fell almost 10% a year. So again, that's either party in, some of it's mixed in Congress gridlock. But again, we're companies in the U.S. are innovative. They're investing and they're creating jobs, and the stock market kind of rewards them over time, and they go up and to the right.
Yeah, I know there's probably some viewers sitting there thinking, well, what happens if we get, 9/11 or financial crisis or COVID right when I retire? Well, the reason you work with an advisor here at Paladin is we are building your portfolio so that the portion you need tomorrow is got no exposure.
Yeah.
So it doesn't matter if the stock market dropped 30%.
Don't like it, but
You don't like it, but the money you need for the next 3 to 5 years isn't moving at all.
Yeah.
That's where we come in as far as using the building blocks to build your overall allocation. Over time, though, good things happen. Another good one here. This goes back almost 100 years.
Yep.
We see the green boxes. Those are years where the stock market was positive. So the first column of green was 0 to 10%, 10 to 20, 20 plus. The red are years that the stock market was down. Almost 75% of the time, the stock market's positive for the year. And I think those next 2 points are some of your favorite. Let you talk about.
Yeah, I mean, so that number itself is fantastic, right? So almost 3/4 of the time the markets are positive. I don't think you gamble a whole lot, Matt, if you did, but if you were to go to a casino or somewhere and they're going to pay you up 75% of the time, you'd probably think that's a good place I want to be putting some money towards.
Sit down for a while.
That you sit down for a while, right? So 73% of the time the market's positive. What's even more, I think, of the last 2 points you just talked about is the number of down years in this 96, 97 years is 26 years. So okay, that's uncomfortable, right? 26, but again, that's only 27% of the time. Now the number of plus 20% years is actually 37 years. I mean, that's way more than the number of down years. That's a 20% year is a big year, right? We had one last year. This year we're borderline on 20% as well. Those are some big numbers. And to think that you have 37 of those out of your 96, 97, about a third of the time you get some big up years. So again, not everything's up. I wish it was up and to the right, but the fact that you have those many big years and there's only 26 down years every day. I mean, if you're down like 0 to 10%, there's only 26 of them.
Yeah, and generally, if you spend some time studying this, those big years in the red are followed by bigger years in the green.
For sure.
So that just goes back to the point of not letting current events spook you and sticking with your plan, because for every decline, there's going to be an even better
Rebound.
rebound.
Yeah, everybody's worried about the last one, that box of 2008, right, in the great financial crisis when the markets are down 30-some%. So that's what everybody's fearful. If you've been around for a while and most of your clients are retired, that's what they're fearful for. But that's a very infrequent year. I mean, that's one, there's only 3 years that have been down more than 30% in 100 years. So it doesn't happen very often. But on the flip side, there's so many years that are actually, I think it's actually 21 of the years are above 30%. So that's like 7 to 1 ratio of, 30% plus or minus years.
And 2008 will happen again, or some variation of it, but you need to build your plan so you can withstand it. And if you're just out there, without a plan and thinking, I can figure it out myself, like, it might be worth having a consultation with somebody.
For sure. You guys do a great job of, again, diversification, have that plan up front so you don't get spooked in that 2008 situation when you should actually probably be reallocating your safe money back into the market.
Yeah, that's an opportunity. That's an opportunity, actually. So what can you do? And this, should be clear at this point, is don't let short-term current events make portfolio decisions for you. Avoid the emotional decision. It's okay to be concerned when something bad happens or there's something uncertain on the horizon, but that's why we're here. We try to take the emotion out of it. We're investors in the stock market too. We don't want it going down, but we're here to help navigate that. We have great resources at our disposal to help. All right, dig a little bit deeper beyond what CNN and Fox Business or Fox News is saying and see what's actually happening.
Yeah. Sometimes it's good to turn that stuff off for a while.
Yes. Revisit your risk tolerance. We talked about that. So we do the risk assessment when we first get to know you, and then we revisit it every single year. That helps guide us on whether or not your portfolio mix is okay. So we might change from one growth strategy to another based on conversations with you or just our outlook. But we're not going to change your portfolio from your risk tolerance, which is why we want to rebalance and also redo that assessment.
Yeah, and then what we do as active portfolio managers, if we think the market's going to soften a little bit, like in that core select portfolio, I'll sell some of my high expensive, more growthy stocks and buy more staples and kind of defensive things as well. So that's how we do it on the portfolio management side, but you guys do a better job on the allocation on the overall picture.
Yep. So we're not jumping out of the stock market, but we are maybe shifting to be more defensive while still having market exposure. Review your timeline. I hit on that a little bit. So if you're on the cusp of retirement and you've been in your 401k or your TSP or 403b, and you're not sure what you're invested in because you were told just to save and keep investing, which is a good thing. But if you're on the cusp, you want to start protecting some of your assets and getting more in line with your risk profile, because if you need that money tomorrow to fund retirement, you don't want to be sitting over here in the stock market. You might be okay, but it's a lot better to have some certainty built into your portfolio.
Yeah, we're a big believer of time in the market instead of timing the market, that hot cash in, cash out type of situation. So as you get to retirement, what happens? Your income goes away, like you guys talk about, and now you need to rely on your investments and your safe money. So that's why you need to set aside a good plan.
Yep. And then your tax strategy. So I've hit on this already. We're big proponents of this: Roth conversions, Roth contributions, paying your taxes now when you know what they are versus hoping for the best, because whether it's the state of Minnesota or the federal government, we tend to know how to spend money. We don't seem to be doing a great job of saving money.
No.
And the government has a few levers to pull as far as controlling that, and it's either spend less or raise taxes.
Which neither party likes to do. No, honestly, it's like they don't like it. It used to be a little bit more on that side of things, but it's not the case. They both like to spend, so it's the taxes side of things.
So that means taxes have to go up, whether that's personal income taxes, business taxes. So that's why we take a look at your tax situation every time we get together, because we want to make sure we're mitigating that as much as possible. We can't eliminate a lot of these risks, but we can certainly mitigate them and put you in the best position possible. So we're going to switch over to some Paladin news. So just this morning, actually, here in the office, Paladin Financial partnered with Gradient Financial Group and the Gradient Gives Back Foundation to gift the Kessel family 1 year of mortgage payments. We also reached out to a variety of businesses in the area, and they all made a variety of donations. But you can see on the screen here, Gabe, 17-year-old, he's a wrestler, recently diagnosed with brain cancer, a very aggressive form of it. So as you can imagine, there's a lot of costs and a lot of stress that goes into managing something like that. So we got together with Gradient Gives Back, and we donated a year's worth of mortgage payments. And thank you also to all the local businesses that donated. They were very appreciative. It was a very emotional morning.
Yeah, it was.
So event. Thank you to everybody, and that's something we hope to continue doing as time goes on. So thank you to everybody that attended and donated. And if you, as a client sitting out there, have questions or want to know how you can donate as well, just let us know. So additional things coming up here at Paladin. So we have a in-person client education event. So that's going to be held at Forgotten Star Brewery down the road in Fridley. We did an event there earlier this summer. We're going to have a guest speaker, Dave Harris from Nationwide. We're going to talk about the challenges of aging. So hope to see you there. If you have questions on it or want to register, go to our website, give us a call, we'll help you out there. Q4 webinar. So Keith and I hit a little bit on taxes and tax policy. We're going to dive a lot deeper, not Keith and I, but we'll have another speaker talk about taxes and year-end deadlines and just some things you need to get done this year, but also what the outlook is moving forward. And then the Monday of Thanksgiving week, it's a client appreciation event scheduled to be downstairs here at the office. Still working through some construction, but it should be done by then, should be beautiful. So make sure you register for that. That's a pie pickup. So we'll have open house where you can come have food and drinks and pick up a pie for the holidays. So hopefully one less thing you have to worry about for the holidays. You can go to our website, paladinfinancial.com, to register, or just give us a call. Medicare enrollment starts October 15th, so a very busy time now. Most of you are aware this year we added Medicare, so Nikki Foley handles that. That's the theme of podcast coming up in September. We'll do a virtual event at the end of September. There's a lot of changes coming as far as Medicare goes, so make sure you're staying tuned, and if you have questions, of course, reach out to us. So next steps, if you are a client, you're in here regularly, and we're doing a lot of these exercises to make sure your plan's always up to speed. If you are not a client of ours, but find this interesting, and maybe we hit on some hot buttons for you, and you want to have those additional conversations, give us a call. Numbers on the screen, 651-842-8406, info@paladinfinancial.com. Before we go, Keith, one thing I think that makes Gradient Investments unique, and one of the reasons we use them, is they are actually accessible. So not only are they sitting here on the screen with us, but if you have questions about the markets and the economy, they'll actually talk.
Yeah, we'll get on the phone. Yeah.
They're not the CFAs that sit in the ivory tower and are too good to talk to people. They do spend a lot of time watching charts and graphs and whatnot, but we're here to have conversations because it's your nest egg that you've worked decades to build, and we want to make sure we're good stewards.
Yeah, we love working with Paladin. These guys are fantastic. They do a great job. Again, every one of these plans are tailor-made, so it's like every client that comes in, you do the full rundown of what they need, and we love working with these guys, and we love getting on the phone with you guys or sitting in the office and saying, let's have this conversation about this portfolio. What do you think about the market? So we like the access that you guys give us.
Yep, so that's it for today. This presentation will be up on our website here soon. So if you have friends or family that you think would benefit from it, if your neighbor's constantly talking about the election and the stock market, share this with them, rewatch it, riveting stuff. So please, love to hear from you if you have questions or concerns about any of this, and hope to see you at some of our future webinars and events. Thank you.
Here.